Alright guys, today we're diving into Josh Brown's best stocks in the market, with a sharp focus on energy. Josh Brown, CEO of 𝗗𝗟𝗧 Wealth Management, just went on CNBC's halftime report and laid out his top setups in the oil and energy space. What's breaking out, what's on watch, and where the risk lines are. Here's how this is going to roll. First, I'll play you the clip so you can hear exactly what Josh said. Then I'll come back with my reaction and a detailed, plain English breakdown of his picks. What I agree with, where I'm cautious, and how I think about entries, exits, and position sizing. After that, I'll walk you through my own in-depth analysis of the 5 energy names he highlighted and how they fit into the current market tape. If you only watch one video today, make it this one, and watch it to the end. Smash that like button, let's push this to 1,000 likes. Share it with someone who's tracking energy and drop your thoughts in the comments. And if you're new here, hit subscribe so you don't miss the next big investing update. Alright, let's hear what Josh Brown has to say.
And we are back on halftime with Josh Brown's best stocks in the market. Josh, tossing it over to you.
All right. Guys, as you all well know, rooting for the energy sector, being overweight energy in the modern era, it's a little bit like being a Jets fan. Every once in a while, like they'll win a big game and everyone will look at each other and be like, are the Jets for real? And then the next week, oh, wait, no, they're not. And that's been the story with the sector. I don't like the sector right now, but there are some really interesting moves happening within the sector, and yesterday we wrote some of them up. So I want to roll through these with you guys very quickly. These are the 5 best stocks in the energy sector. Valero is number 1. I call this an A+ chart. Let's go ahead and put up a 1 year. This thing is already broken out. So for people who like to anticipate breakouts, this is not the chart for you. For those that are comfortable buying breakouts and are willing to allow for a low volume pullback here in the stock to get long, I would keep it on your screen. This one, the risk management is obvious. I'd use 136 as a pivot point. You can see that is the 200-day. We had a golden cross here in the chart a couple of weeks back. If it breaks below 136, 140, something's changed. We don't want to be long. Marathon is also an A. Not quite an A+, but getting there. There are no sellers here, as you can see. All the sellers have been cleared out. The 200-day moving average is flat. It'll be turning up very soon, like a smile. That's your off-ramp. I'd use the 200-day as my risk management. I have Baker Hughes as a B+, BKR. We've talked about this stock before. It was on the best stocks list prior to Liberation Day. Look at that sell-off in April. It scratched and clawed all the way back. This is the best of the oil field service names. This thing's breaking out. RSI in the 60s, not yet overbought. The August lows at $42 is your stop. So that's your risk reward here. I know it's higher than where it was when I wrote it up yesterday. I wasn't on the show yesterday, my apologies. 2 more very quickly, Frank. Phillips 66, also a refiner, PSX. This is a C, but it could become a B. So I don't want people to get discouraged. It's on the best stocks list, not because of any defined uptrend here. It just happens to be hanging high, and it's been hanging in there for so long that by default it's become one of the better names in the group. Keep it on your screen. I don't love this one. And then there's Chevron. CVX I personally own. I bought it terribly. Right before that huge sell-off this spring, I got long that false breakout. Was totally wrong and had no discipline. I wrote it down and I averaged down. It ended up being the right thing, but that is not what we do with best stocks typically. That said, big dividend, huge buyback. This is not quite a B yet. It's also a C, but it's a chart that could set up. This is the one that I'm hoping, because I'm long, becomes the next big breakout. But as you can see, you got a lot of resistance in the high 160s. If you're conservative, I would almost let that fight happen before pulling the trigger on a long. I don't quite trust it yet from these levels. So those are your best oil energy stocks in the market right now.
First, the big picture. Josh opens by admitting he doesn't love the energy sector overall right now. That's important. He's not making a macro call that energy is back. His Jets analogy sets the tone. Energy can look great one week and disappoint the next. So rather than buying energy, he zooms in on specific setups where the charts and fundamentals look constructive. Translation, he's being selective and tactical, not broad and bullish. He starts with Valero, a refiner, and calls it an A+ chart. When a technician says a plus, they mean the stock has already broken out of a consolidation with strong price action. 2 implications here. 1, it's not a catch-the-bottom idea. The move is already underway. And 2, Execution is all about buying strength without chasing recklessly. Josh gives you a very specific risk line, roughly 136, which he ties to the 200-day moving average and a recent golden cross. That's when the 50-day moving average crosses above the 200-day, often a positive momentum signal. His message: if you buy the breakout, be ready to accept a normal, low-volume pullback. But if price breaks back below that 136-140 zone, something's changed and you don't want to be stubborn. This is classic trend-following discipline. Next is Marathon Petroleum, another refiner. He grades it an A, not quite Valero's A+, but close. The key phrase was, there are no sellers here. That's trader shorthand for persistent demand soaking up supply. Price consolidates high rather than snapping back, and the 200-day is flattening and about to turn up. He'd again use the 200-day as the off-ramp. So the playbook is similar. If you're long, ride the trend and defend the 200-day. If you're flat, buy constructive pullbacks rather than anticipating a breakdown. Then he flips to Baker Hughes, an oilfield services company. He calls it B+, and highlights something that matters to anyone who got shaken out this spring. It sold off hard in April, scratched and clawed back, and is now breaking out with RSI in the 60s. Not yet overheated. In other words, momentum is building but not extended. He even gives you a stop. The August lows around 42. That turns a vibe into a trade. If you like the breakout, your risk is defined. If price loses 42, you step aside and reassess. This is how you keep losers small while letting winners work. He quickly mentions Phillips 66, again a refiner, flagging it as another name with potential, and then one more name he grades as a C, that's hanging high. The point of that aside is to separate genuine uptrends from stocks that are just refusing to break down. A C for him isn't a short, it's a watchlist name that needs more proof. Don't confuse not breaking with leading. Finally, Chevron. This is where he gets personal. He owns it. He bought badly into a false breakout, averaged down, and it worked out. But he's clear that averaging down is not part of his best stocks discipline. Why share that? Because even pros slip, and the lesson is about process. He still grades the setup as a C today, not a B, and warns there's heavy resistance in the high 160s. If you're conservative, let the stock prove it can win that fight before going long. That's patience over prediction. Now Joe's response adds a crucial layer, the why now for refiners. He says refiners have stood out over the last 6 to 8 weeks because the foundation of their outperformance is a low, stable oil price. Think crude in the low 60s. That's exactly the environment where refiners' margins can improve. Input costs, crude, aren't spiking, while refined product cracks can hold up. So the chart strength in Valero, Marathon, and Phillips 66 isn't random. It maps directly to the macro backdrop refiners like. He also admits to a portfolio management mistake a lot of investors make, getting over-levered across highly correlated names. He owned all 3 refiners and pared back by selling Marathon, which right now looks like a bad idea. That's a great risk lesson. Even when your thesis is right, refiners outperform, sizing and diversification still matter. Concentration can boost returns, but it also amplifies regret when you trim the wrong one. There's another nugget in Joe's comment: activism at Phillips 66 via Elliott Management. Activists push for operational improvements, asset sales, buybacks, or capital allocation changes, any of which can catalyze a lagging chart to catch up to peers. That's why Josh keeps PSX on the list even though it hasn't broken out like VLO MPC yet. It's a setup that could pivot from C/B-ish to A if price confirms. Let's unpack a few of the technical terms Josh used so you can map them to behavior. A breakout is price moving above a well-defined resistance level on strong participation. Those work best when followed by a low-volume pullback that holds prior resistance, now support. A pivot point, like his 136 on Valero, is a line in the sand. Lose it, you're wrong. The 200-day is the market's long-term trend filter. When price is above and the slope is turning up, the wind's at your back. RSI in the 60s means momentum is positive but not frothy. Over 70 is where many traders start watching for exhaustion. So what's the practical playbook if you're thinking about energy after that segment? First, separate refiners from producers/services. They are different businesses with different sensitivities. Josh's A/A+ grades clustered in refiners because the current tape, stable crude, strong product demand, favors their margins. Services represented by Baker Hughes is more cyclical and tied to capex and drilling activity. It's improving, but it's a B+ with an explicit stop, not an all clear. Super majors like Chevron come with dividends and buybacks but also heavy resistance zones and headline risk. Today, that chart still needs to prove itself. Second, if you buy strength, adopt Josh's risk lines. For a VLO-style breakout, accept the idea of a pullback that tests the breakout, but respect the 200-day or his pivot zone. For BKR, use the August lows as your risk. For PSX, let activism be a tailwind but still require price to confirm. And if you're long CVX for income, recognize the trade-off. You get the yield but you also need patience as it bumps against the high 160s ceiling. Third, watch your sizing. Joe's confession about owning all three refiners is relatable. If you want exposure to the same theme, you don't necessarily need 3 tickets to the same ride. 1 or 2 positions sized appropriately can express the view without over-concentrating. Finally, remember the opening caveat. Josh doesn't love energy as a group. This is not a buy anything with a barrel moment. It's a market of stocks, not a stock market, especially inside a volatile sector. That's why his segment was full of stops, pivots, and grades. The grades aren't about the company's quality as businesses. They're about the quality of the current setup. An A+ setup can become a C with one bad breakdown. A C can become a B if price starts to lead. Your edge is updating those judgments as the tape evolves. To wrap, here's my distilled takeaway from what Josh said and what Joe added. If you want energy exposure right now, refiners have the momentum, services has a tradable breakout with defined risk, and the integrated giants are still prove-it stories. Use the 200-day and recent swing lows as your guardrails. Favor names already breaking out unless you have a catalyst-driven reason to preposition like activism at PSX. Don't overstack the same theme, and most of all, trade the setup you see, not the sector story you hope for. That's how you avoid feeling like a Jets fan next week. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, let's dive in deep into the 5 best energy stocks to buy right now. First up, Valero Energy, ticker VLO. This company is a titan in the energy sector, known for its robust operations and strategic foresight. Valero is the world's largest independent petroleum refiner, a title that speaks volumes about its capacity and reach. This scale gives Valero unmatched efficiency and the ability to leverage economies of scale, making it a formidable player in the industry. Their ability to process crude oil at lower costs means they thrive when the cracks spread. The difference between crude and refined products widens. This financial metric is crucial for refiners, and Valero's expertise in this area gives it a significant edge. Right now, global fuel demand is strong, and Valero is capitalizing on this trend by maximizing its output and efficiency. They've invested heavily in upgrading refineries to handle cheaper, lower-quality crude, which boosts profit margins regardless of oil prices. This strategic investment ensures that Valero remains profitable even when market conditions are less favorable. This operational excellence is backed by a management team that's always optimizing for profitability, ensuring that every decision is made with the bottom line in mind. Valero is a cash flow machine, rewarding investors with a generous, well-supported dividend and aggressive share buybacks, which enhance shareholder value. Valero Energy stands out with a market cap of about $54.06 billion, generating $129.88 billion in revenue for 2024 and $2.76 billion in net income. On a per-share basis, that's EPS of $2.48, which at today's valuation translates to a PE of 70.17. Pricey on current earnings, but the market is clearly paying up for the cash flow profile and refining margins. The dividend yield is attractive, providing steady income while you wait for further appreciation in the stock price. Despite its strengths, Valero trades at a low price-to-earnings ratio, making it a classic value play that savvy investors should consider. The market hasn't fully priced in its earnings power or dominant position, presenting a potential opportunity for those who recognize its value. Concerned about the future? Valero is already a leader in renewable diesel, turning waste oils into clean fuel, a profitable and fast-growing business. This innovative approach not only diversifies their revenue streams, but also positions them well for a greener future. This strategic pivot shows management is preparing for the energy transition, leveraging existing infrastructure for new growth. By retrofitting existing refineries, Valero can efficiently transition to renewable fuels without massive new investments. Valero's fortress balance sheet means it can weather downturns and seize opportunities when others can't, providing a level of security for investors. Analysts are bullish, but there's still plenty of upside as the market catches on to Valero's full potential. Global demand for refined products, especially in developing countries, remains robust, even as EVs grow, ensuring a steady market for Valero's products. Valero is perfectly positioned to meet that demand with its extensive network and efficient operations. In summary, Valero offers value, income, and growth with a future-proofing strategy that sets it apart from its peers. For anyone seeking a high-quality energy stock, VLO is a must-watch, offering a compelling mix of stability and growth potential. The combination of operational excellence, shareholder rewards, and smart investments in renewables makes Valero a standout in the energy sector. If you want a company that's thriving today and preparing for tomorrow, Valero deserves a spot on your list of top energy stocks. It's a best-in-class operator with a clear vision for the future, ensuring long-term success. Don't overlook this refining king. Valero is built to deliver exceptional results. The company's financial strength and strategic foresight make it a compelling buy for any serious investor. As the energy landscape evolves, Valero is leading the way, blending traditional and renewable energy sources seamlessly. This is more than an oil company. It's an evolving energy powerhouse ready to tackle the challenges of tomorrow. For investors, that means opportunity and potential for significant returns. Keep VLO on your radar as a top contender in the energy sector. Let's move to our next pick. Up next, the Downstream Giant. Next up, we have Marathon Petroleum, ticker symbol MPC, a name that stands tall in the world of energy. Marathon is a true downstream powerhouse, seamlessly blending refining, pipelines, storage, and a vast retail network into one integrated operation. This integrated model is a major strength. When refining margins get squeezed, their midstream and retail segments step up, keeping cash flowing and profits steady. Picture their pipelines as toll roads. No matter what's happening with oil prices, these assets generate steady, high-margin income, providing a reliable backbone for the business. Their Speedway retail chain is a profit engine in its own right, driving high-margin sales inside the store, not just at the pump. Snacks, drinks, and essentials all add up to a significant revenue stream. Marathon is relentless in returning capital to shareholders. They're known for aggressive share buybacks and a solid, growing dividend that rewards investors year after year. The dividend is well covered by robust free cash flow, and those buybacks have significantly boosted earnings per share, making each share more valuable over time. Financial discipline is a hallmark of Marathon's strategy. They've reduced debt, strengthened their balance sheet, and built flexibility to weather any market cycle or economic downturn. Even after a strong run in the stock price, MPC still trades at a reasonable valuation. The market often underestimates the stability that comes from their diversified earnings streams and integrated business model. But Marathon isn't just about traditional oil. They're investing heavily in renewable fuels, converting refineries to produce clean diesel and gasoline, and positioning themselves for the energy transition. This forward-thinking approach not only prepares them for a lower carbon future, but also opens the door to lucrative government incentives and new revenue streams. For investors seeking upside with less risk, MPC's diversified model and focus on shareholder returns make it a compelling choice. You get growth potential, income, and stability all in one package. With Marathon, you gain exposure to refining, midstream, and retail, all the key segments of the energy value chain bundled together. Marathon is firing on all cylinders, adapting for the future while continuing to reward investors today with strong performance and returns. It's a high-quality company with a best-of-all-worlds approach, combining operational excellence, financial strength, and a vision for the future. Marathon Petroleum follows in the same lane but with a different mix. A $59.22 billion market cap on top of $138.86 billion in 2024 revenue, turning that into $3.44 billion of net income. EPS comes in at $6.87, and the stock trades at 28.36 times those earnings, a multiple that suggests investors see steadier profitability ahead versus the volatility we've seen in prior cycles. If you want stability, growth, and income, MPC stands out as a top pick in the energy sector, offering a rare blend of all three. Their strategy is working, and the market is starting to take notice as Marathon continues to deliver results. Don't miss out on this downstream giant, an industry leader with a proven track record and a clear path forward. Marathon is more than just a refiner. It's a diversified energy leader shaping the future of the industry. Keep MPC on your watch list and consider it for a core position in your portfolio if you're looking for a balanced energy investment. Now let's look at a company inventing the future of energy. Enter the tech pioneer. Third, Baker Hughes, ticker BKR. This is a company that's been quietly transforming itself from a traditional oilfield services provider into a true technology powerhouse at the heart of the global energy transition. Baker Hughes is an energy technology leader, powering both traditional oil and the future of clean energy. Their reach extends across continents, supporting energy infrastructure in over 120 countries, and their innovations are shaping how the world produces and consumes energy. Their oilfield services segment provides essential tools and services for global oil and gas exploration. From advanced drilling systems to digital monitoring, they help clients maximize efficiency and safety in some of the world's most challenging environments. As drilling activity ramps up worldwide, Baker Hughes is a direct beneficiary. Increased demand for oil and gas means more contracts, more equipment in the field, and more revenue flowing in. But the real growth engine? Their industrial and energy technology segment. This division is where Baker Hughes is truly setting itself apart, investing heavily in next-generation solutions. Baker Hughes is a global leader in LNG technology, hydrogen, and carbon capture, key pillars of the energy transition. Their expertise is helping countries and companies reduce emissions and shift toward cleaner energy sources. Demand for LNG is exploding as countries seek energy security and cleaner fuels. Baker Hughes is at the center of this surge, providing the technology that makes large-scale LNG production and transport possible. Multi-year, multi-billion-dollar LNG projects provide predictable, high-margin revenue. These long-term contracts help insulate Baker Hughes from short-term market swings and create a stable foundation for future growth. Their expertise in hydrogen and carbon capture positions them at the forefront of decarbonizing industry. As governments and corporations set ambitious net-zero targets, Baker Hughes is the partner of choice for implementing real-world solutions. This dual strategy, serving today's energy needs while building tomorrow's infrastructure, sets Baker Hughes apart. They're not just adapting to change, they're driving it, bridging the gap between legacy energy and the future. Financially, they're strong with a solid balance sheet and accelerating free cash flow. Their disciplined approach to capital allocation means they can invest in innovation while rewarding shareholders. The stock trades at a discount to peers, with the market underestimating its growth potential. This creates an opportunity for savvy investors to get in before the broader market catches on. As their new tech segment expands, expect a re-rating and higher share price. The market is starting to recognize Baker Hughes as more than just an oilfield services company. Baker Hughes is more than a cyclical oil service company, it's a long-term industrial growth story. Their transformation is unlocking new revenue streams and future-proofing the business. Management is focused on profitability, streamlining operations, and investing in high-return projects. Their leadership team is committed to driving sustainable growth and innovation. The company sits at a $49.26 billion market cap, with $27.82 billion in revenue and $2.97 billion in net income for 2024. That works out to EPS of $3.06 and a notably lower PE of 16.33, which positions it as the more value-tilted way to play upstream activity and global energy capex. For investors, BKR offers exposure to both the current energy cycle and the future of clean energy. It's a rare opportunity to benefit from both stability and innovation in one stock. It's a unique blend of stability and growth. Few companies can match Baker Hughes's ability to thrive in both established and emerging energy markets. If you want to invest in the energy transition, Baker Hughes is a smart choice. Their technology, scale, and global reach make them a leader in this critical shift. The company is enabling the entire energy ecosystem, old and new. From oil fields to renewables, Baker Hughes is building the backbone of tomorrow's energy landscape. Don't overlook this tech pioneer. As the world's energy needs evolve, Baker Hughes is positioned to lead and capture new opportunities. BKR is poised for significant upside as the world's energy needs evolve. Their innovation pipeline and global partnerships are just getting started. Add Baker Hughes to your watch list. This is a company with the vision and capability to shape the future of energy. Next, let's talk about a diversified powerhouse. Here's why Phillips 66 stands out. Fourth, Phillips 66, ticker PSX. Phillips 66 is more than a refiner. It's a diversified energy giant with four key segments: refining, midstream, chemicals, and marketing. This diversification smooths out earnings and makes PSX resilient through market cycles. Their refining segment is a cash cow, but midstream assets provide stable, fee-based income. The real differentiator? Their chemicals joint venture with Chevron, CPChem, a global leader in petrochemicals. Demand for chemicals and plastics is rising worldwide, and CPChem is perfectly positioned to benefit. Their marketing segment connects directly to consumers, adding another layer of stability. PSX consistently rewards shareholders with a strong growing dividend and steady buybacks. The stock trades at a discount to the S&P 500, with a dividend yield well above average. The market undervalues its diversified business mix, focusing too much on refining. Phillips 66 is also investing in the energy transition, converting refineries to produce renewable fuels. Their Rodeo Renewed project will make them a leader in renewable diesel and sustainable aviation fuel. Management is committed to innovation and sustainability, building new growth platforms for the future. Phillips 66 has a market cap of at $143.15 billion in revenue for 2024, converting to $2.1 billion in net income. With a $56.25 billion market cap, EPS of $4.21, and a PE of 32.94. This one sits between Valero and Marathon on valuation, leaving room for catalysts, operational improvements or capital allocation to close the gap with peers. For investors, PSX offers value, income, and diversified growth. Its asset quality and balanced model provide rare stability in the energy sector. If you want a blue-chip energy stock with multiple growth avenues, PSX is an outstanding choice. The company's forward-thinking strategy sets it apart from traditional refiners. Phillips 66 is built to thrive in both today's and tomorrow's energy markets. Don't miss this diversified powerhouse. PSX deserves a spot in any long-term portfolio. Now, let's finish with a global leader. Here's why Chevron is the ultimate energy stock. Finally, Chevron, ticker CVX. Chevron is a global energy supermajor operating across the entire value chain: exploration, production, refining, and retail. Their integrated model provides scale, diversification, and resilience through all commodity cycles. Chevron's portfolio of long-life, low-cost assets ensures profitability even when oil prices dip. Their LNG projects and Permian Basin operations are world-class, supporting decades of production. Chevron is a dividend aristocrat, raising its dividend for over 35 consecutive years, through every crisis. Massive share buybacks further reward investors, returning billions in cash. The stock trades at a discount to the market, with a top-tier dividend yield. Chevron is investing in the energy transition, renewable fuels, hydrogen, and carbon capture, focusing on areas where it has a competitive edge. Their disciplined approach means only high-return, lower-carbon projects make the cut. Strategic acquisitions, like Hess, strengthen their portfolio and secure future growth. Chevron's pristine balance sheet gives it flexibility to invest, weather downturns, and seize opportunities. Chevron carries a market cap of $323.76 billion, posted $193.4 billion in revenue, and $17.6 billion in net income in 2024, and prints EPS of $7.77. At 20.68 times earnings, the multiple reflects the balance of scale, dividend strength, and the push-pull of commodity prices across its upstream and downstream businesses. For investors, CVX offers stability, income, and disciplined growth. You get exposure to the entire energy chain from production to the pump. Chevron's track record of shareholder returns is unmatched. It's the quintessential sleep-well-at-night energy stock. If you want a core holding in the energy sector, Chevron is a top choice. The company is built to last, adapting for a sustainable future. Don't overlook this global leader. CVX is a must-have for any serious energy investor. Chevron combines reliability, innovation, and value. Add it to your portfolio and watch it deliver. That wraps up our top 5. Here's your next move in the energy market. There you have it, 5 energy stocks perfectly positioned for today's market and tomorrow's transition. Taken together, refiners like Valero, Marathon, and Phillips 66 offer leverage to cracks in product demand, Baker Hughes gives you exposure to the services cycle at a discount multiple, and Chevron provides the blue-chip diversified anchor with cash returns, each slotting into a different role depending on whether you want momentum, value, or stability in your energy sleeve. Focus on companies with strong balance sheets, disciplined management, and a clear strategy for shareholder returns. Want to level up your investing? Check out my Value Stocks Investing Master Course, link in the description. You'll learn how to spot undervalued companies, build a high-quality portfolio, and protect your investments. For exclusive stock tips and in-depth analysis, join the Stocks Galore Patreon, details below. Now, which of these energy stocks do you think has the most growth potential? Let me know in the comments. Don't forget to like, subscribe, and share your thoughts. Thanks for watching, and I'll see you in the next one. Stay smart, invest wisely. Until next time, keep building your financial future.